Welcome to the discussion on the Risk Readiness Assessment. If you're on the home page, you can click on the Products box and it will give you a pull-down menu. If you select Risk Readiness Assessment, it'll provide you with a description, the purpose, and the directions for scoring the assessment. When you log in, you'll find yourself on the Readiness Level Summary page. Here you have two options to open the risk assessment. First, you'll find access in a pull-down menu under the box labeled Tools, and the other is in the permanent display box on the right side of the screen. Clicking on either will open up the risk survey. Most of the venture capital tools have a feature that provides insight into the importance of each of the assessment questions. To get access to this information, click on the circle with the question mark inside it. Clicking on the question mark will open a dialog box that provides insight into the importance of the question. The purpose of the Risk Readiness Survey is to identify how much risk has been removed from the business venture, appropriate for its stage of development. While many investors do not use a systematic or routine analytical structure for making an investment decision, research indicates there are 5 fundamental risk factors involved in that decision process. They include execution risk, product risk, market risk, management risk, and financial risk. In the example above, the execution risk score is 30%. This means 30% of the potential risk associated with executing the business plan has been removed. Most investors would require a total score above 70% for a startup venture to get funded, and a score above 90% for a later stage company to get funded. It's also important to note that if the total score is above 70%, if any one of the risk scoring factors falls below 70%, such as the 50% financial risk score above, it will not likely get funding. Each of the 5 primary risk areas consists of 5 assessment points, making a total of 25 assessment points. The first risk factor is the execution risk. The 5 assessment points in this section address entrepreneurial, financing, location, circumstantial, and business model points. It's important to remember that many external factors beyond the control of the entrepreneur can affect the attitude and the capabilities of the investor. But basically, when thinking about execution risk, investors are asking themselves, is this the right entrepreneur with the right business model at the right time and with the right product to solve a large and growing market opportunity to generate for me an extraordinary return on investment? The second risk factor in the assessment is product risk. This section addresses product status, competition, intellectual property, product portfolio, and applications. Product competitiveness point is probably the most challenging assessment point to address within all the assessment tools on the site. It requires thoughtful consideration. For instance, if a product was 3 times less expensive, had 4 times as many measurable benefits, and had a potential user market 3 times as large as the competition, it would qualify as a 10 times improvement. Likewise, a product that costs 10 times less than the competition also qualifies as a 10 times improvement. Market risk is the third factor. This section addresses sales, market size, customer base, competition, and growth factors. Overall, what the investor looks for here is the degree of market potential and market validation. The ultimate market validation is not only generating sales, but also generating repeat and referred customers. For startup ventures, the need for rigorous and reliable market research to quantify and characterize the target market for the venture's product cannot be stressed enough. Finance risk is the fourth risk analysis. Financial analysis consists of first financially modeling the market opportunity in a forward-looking 5-year pro forma. This pro forma is one of the single most important aspects of the long-term business plan. The pro forma will determine how much and when capital infusion is needed by the company. And of all the financial elements in the pro forma, the single most important element is the EBITDA, that is, the earnings before interest, taxes, depreciation, and amortization. EBITDA is one of the first factors an investor looks at when initially scanning a business plan. EBITDA will tell the entrepreneur and the investor whether or not it initially qualifies as an investor deal. EBITDA factors significantly in deriving a venture valuation. A reasonable and mutually acceptable valuation eventually determines whether an investor will write a check or not. The management risk is the last risk area in the assessment, but certainly not the least important. Generally speaking, the management factor is given the highest consideration by investors. Investors are the first to recognize they are often entering into a long-term personal relationship with the entrepreneur, depending upon the style of the offering. Investors prefer but do not require that entrepreneurs have significant experience within the market area of the venture, and prefer entrepreneurs with small business experience. Investors are putting more and more value on the talent, experience, and network contacts of members of the advisory and corporate boards as well. When you've completed the assessment, click the Calculate and Save box at the bottom of the screen to generate your risk profile. This concludes our discussion on the risk assessment.